Hello everyone and welcome to this video. Today we will discuss IFRS 11 named as joint arrangements. So for the background, many companies today they don't work alone. They collaborate, share projects and invest together to reduce risk and cost. But when two or more companies work together, how should this be shown in accounting records? IFRS 11 answers this question by explaining how joint arrangements are identified, classified, and accounted for. Let's start with the definition of IFRS. So, IFRS 11 explains how to identify and account for joint arrangements where two or more parties share control, classifying them as joint operations or joint ventures based on the rights and obligations of the parties involved. This means the focus is not on the ownership percentage, but on what rights and responsibilities each party has. Moving forward to the scope of IFRS 11. So, in order for IFRS 11 to apply, there is must that there is a formal agreement between two or more parties, and most importantly, IFRS 11 applies only when joint control exists. What is joint control? Joint control means that important decisions cannot be made by one party alone. All parties must agree unanimously on major decisions. If all these conditions are met, then IFRS 11 must be used. On the other hand, where IFRS 11 does not apply, it excludes arrangements where joint control is not present, even if you have a significant stake, like in the case of simple investments, subsidiaries which are controlled by one company, or associates where there is significant influence but not shared control. In these cases, other IFRS standards are applied as mentioned on the slide. There are two types of joint arrangements, and the classification depends on the rights and obligations of the parties. First one is the joint operation. So, in a joint operation, there is no separate business entity. Parties share assets and liabilities directly. They also share income and expenses. The interest of the parties is in assets and liabilities. Each party records its own share of assets, liabilities, revenue, and expenses in its own books. This means their accounting is done just like normal business transactions. Let's look at it with the help of an example. So here I have taken example of a Pacific Bridge project. The scenario is two firms, A Build and B Construct, agree to build a bridge. No separate legal company is created. They simply work under a joint contract. So they have decided that ownership of that bridge will be 50-50%. What are the particulars of this project? Machinery assets worth 4 million, debt liabilities worth 1 million, revenue 3 million, expenses 1.8 million, profit 1.2 million. Okay, so here we will see the accounting for A build company. So share calculation is 50%. We see that of total of 4 million assets, since the for 50% share, A build records 2 million in its balance sheet. For liabilities, 1 million, half is 500,000. Revenue 3 million, half is 1.5 million. Expenses 1.8 million, and we will record half of it, that is 900,000, and same goes for the profit. So how is this recorded in the balance sheet? Of A build, machinery worth 2 million, debt 500,000. And for the income statement, revenue, expenses and profit goes by these amounts as I've discussed here in the income statement. So this is how joint operations work, and same will go for the B construct company. Okay, now moving forward to joint ventures. So, in a joint venture, a separate legal business entity is created. Parties have no direct control over assets, their interest is only in the net assets, and it is treated like an investment in shares. So, joint ventures are accounted for using the equity method under IES 28. Let's understand this with an example. Okay, so here we have taken example. Two tech firms, SoftCorp and Data Systems, incorporate a separate legal entity called Cloud Sync Limited to sell cloud storage. So here a separate legal entity is created by these two firms, and again they have decided that ownership will be 50-50%. So the financials of this joint venture will be total assets 6 million, total liabilities 2 million, revenue 4 million, expenses 2.8, and profit 1.2. So what are the net assets? Total assets minus total liabilities 6 minus 2, 4 million are the net assets, or in other words the equity. So profit is 1.2 million. So how soft corp will record it, since its share is 50%? So among the 4 million net assets, 2 million will belong to soft corp, and among the 1.2 million profit, 600,000, half of it will belong to soft corp. How it will record it in its balance sheet? No separate, it will not add it into the previous assets liabilities. It will create a new non-current asset investment in joint venture with the amount of 2 million. And in the income statement, the share of profit from JV will be recorded with the amount of 6 million. Here I've also for like just information that if this JV pays dividend to Softcorp, for example, they have received this Softcorp has received dividend of 300,000 from CloudSync. Then what will happen? Then its total initial investment will decrease by this amount. So you see that investment balance after dividend is reduced to 1.7 million. And in case of profit, this will increase by the profit amount. So now it will be 2.6 million. So this is how it works. I will explain the equity method in the next slide with more detail. Hope everything is clear by now. So let's go through equity method to better understand accounting procedure for joint ventures. So in equity method for joint ventures, we see that the investment is initially recorded at cost. Then the investment is increased or decreased by your share of profit or loss. The investment is reduced when dividends are received, and it is shown as one line investment on the balance sheet, and only one share of profit line appears in the income statement. So this keeps the accounting simple and clean. Again, in another example, so partner A holds 40%, and here I have changed the percentages so we can better understand it. And partner B holds 60% of Solar One JV Limited, which is a separate company. Both must agree on all major decisions, example of a joint control. So the initial investment, partner A pays 400,000 since their share is 40%. So how they will record it? They have initially invested, investment in JV is 400,000. Now, in case the JV earns profit, so the JV has earned 100,000 in profit, and the share of partner A was 40%, so this is 40,000. Now, they will, in income statement, they will show a profit, share of profit, which is 40,000, whereas in balance sheet, the investment value rises to 440,000. So, you see that this profit is added to the initial investment. But in the case the JV pays a dividend to the partner A, then what will happen? They have paid a dividend of 10,000, so their cash will increase of partner A since they have received cash, and also balance in the balance sheet the investment value is reduced to 430,000. Like the initial investment which was increased by the profit is now decreased by the dividend. So this is how the equity method works. Okay, so now let's move forward to the core rules of IFRS 11. Okay, for the recognition, each company recognizes its specific share of assets, liabilities, revenue, and expenses under joint operations, And in joint ventures, you record one line investment on the balance sheet and show one line share of profit in the income statement. So, for measurement, joint operations are measured following relevant standards like IS 16 or for equipment or IS 2 for inventory, while joint venture is measured using the equity method under IAS 28 only. Presentation. Joint operations present items under their respective headings, for example, cash, property, plant, and equipment, whereas in joint ventures, they are presented as investment in joint venture under non current assets. What are the disclosure requirements? Companies must disclose nature of joint arrangements, key financial information, major commitments, and risks which are governed by IFRS 12. So let's look at the framework. So five-step approach to IFRS 11. To apply IFRS 11 correctly, take a look at these steps. So first of all, check for a contractual agreement. Confirm if the arrangement gives two or more parties joint control. That is very important. If the joint control is absent, IFRS 11 does not exist. Identify activities of the arrangement. Assess if you have rights to assets or net assets, and then classify them as a joint operation or a joint venture accordingly. Okay, what are the common mistakes to avoid? Assuming ownership percentage decides treatment. Don't assume a 50-50 split automatically means joint control or that a 40% stake cannot be a joint venture. Ignoring contract details. Ignoring the details in the contract which defines the actual rights is a mistake. Accidentally mixing the accounting operations for joint ventures and joint operations. And lastly, never record assets on your books that you do not actually control or have right to. What are the key takeaways? So IFRS 11 applies only when joint control exists. This is very important, which requires unanimous consent. Like every decision made in that arrangement must be agreed upon by all the parties involved. Only two types of joint arrangements exist, and classification depends on rights and obligations. And here they are joint operations and joint ventures. And correct classification is important for accurate financial reporting. Yes, so that's it for IFRS 11. Thank you so much for watching this video. I hope you found it helpful. See you there. Take care. Bye bye.